Per usual, everything on this channel is for educational purposes only and is not intended as financial advice. It's Macro Monday. Let's take a look at some charts. And really, we're looking at this stuff. Started this series months and months ago because everything is getting increasingly related as BTC gets bigger, as BTC products are available to legacy players. That includes the ETFs. Globally, we saw a rise around 433 million last week, most of that being BTC. But overall, it's pretty obvious based on this flows chart, we are not seeing sustained flows. You can see price in this chart. You can see the highs and the lows in price in this chart. There's not been a consistent message from the market that things are headed in one direction. It's been very much back and forth, back and forth, back and forth. Even still, even with the past 6 months of downward chop, of bearishness, we are still the best performing asset year to date. And it's going to be very interesting where this chart ends up at the end of the year. If, let's say, this bumps from 40 to 80 or drops below gold, drops below SPY, below 20%. But it's probably unlikely that it'll lose its top spot, I'd imagine. And this is why when BTC runs, almost nothing else matters, price-wise. Come for the tech, stay for the price action. That's pretty much how it is for most people. A lot of this stuff is done well. They're going to tell you to diversify, volatility, drawdown. I get it. That's all fine and well. But this chart says a lot, speaks volumes for what to expect on up years versus down years relative to everything else. Looking at the calendar this week, the only thing that really matters is going to be FOMC. It's going to be Jay Powell at 2:30. There's a rate decision. Is it going to be 50? Is it going to be 25? We'll see. I don't have any insight one way or the other. It looks like they want to go 50. Whether or not they will, we'll find out. And I wouldn't try to trade around what you think they're going to do, because either way, someone's going to be upset. If they go 50, bears are going to get bearish. If they go 25, bulls are going to get bearish. I don't know, right? It's going to be all over the place. Let's see what happens at 2 on Wednesday in regards to the actual decision. And then we'll go from there. Press conference, Paul may discuss QT, may discuss forward guidance. We'll see, right? We don't know. But what we do know is inflation headed in one direction. We can pick this apart in any way you want, in any metric you want. Year over year, inflation is down. That is not the issue. The issue is aggregate inflation. You're losing a quarter of your purchasing power since 2020. But undeniably, inflation based on the data, the real-time data, continues to decline. We can talk about core and super core and all this other crap. It doesn't really matter. It's all coming down eventually. So for the people who think we shouldn't cut, I ask them, where do you think inflation is headed? And why shouldn't we cut? Where do you think unemployment is headed? And why shouldn't we cut? There's this yin and yang between we're not there yet, we need to get there, versus we are quickly heading there and we don't want a deflationary crash. The UK is more back in balance here, hovering around 2 to 3%. The September CPI, that's this month's print for next month, currently 2.29. PCE, this month's PCE, which is going to be next week, 2.33 is estimated. And again, I ask people, okay, if you don't think we should cut, why? Because we are there. We will be there within the next couple months. As a reminder, there's no meeting in October. Real rates still high and restrictive. GDP also fine. No indications of recession here based on GDP now. And if we look at another metric for CPI using observed rent versus the CPI calculation for rent, we have been there since July. So instead of cutting in July 25 and September 25, there's going to be this mad frantic dash on whether or not they're cutting 50 in this meeting and what it means and all this other stuff. Is the Fed behind? They could have headed this off at the pass and just said 25, 25, go from there. But they made their bed, now they're going to lie in it. We also have container freight costs coming way down, something that many people were highlighting as a potential reinvigorator for inflation. Not quite seeing that. Haven't seen that yet, right? If this makes its way into inflation, we're going to see it in trueflation first. So across the board, it looks like rates have crested for most countries, G7, G8, outside of Japan, which is on the rise here. So do I want to be long or short risk when rates are coming down? If I have to make a trade, it's going to be long, but obviously you need to be cognizant of recessionary risks. But I really don't want to be short risk if rates are coming down, if liquidity is moving up. These are the central bank rate decisions this week. Fed, BOE, and BOJ are the big three. BOE and BOJ not expected to do anything this week. Fed expected to start cutting, obviously. And if we look across the board, again, we're seeing this column of last move going from hike to cut across the board globally where it makes sense. So the direction of rates for most countries are headed to a place that is beneficial, that is a tailwind for risk assets. If we look at the World Central Bank Liquidity Heat Map from Cross-Border Capital, this is also shifting from red to green across the board, Europe, Asia, America, Africa, everywhere. Again, I ask you, is this a time to be short hard money if liquidity is rising? That's all I'm saying. Something to think about and to consider. Nothing is a guarantee. Nothing is a foregone conclusion expectation. But if we're talking about when and why bullish moves on risk happen, it's off this type of backdrop. Rates down, liquidity up. One last thing about liquidity, the reverse repo, which largely was why we saw the move we saw in 2023 into 2024 for risk assets, has continued to dwindle, slowly dwindling lower. A lot of this is buying front-end treasuries instead of sitting in the reverse repo. And this is also a ticking clock here for the Fed, where if liquidity runs dry, continues to run drier, we risk an economic accident where they're going to have to intervene. So the time has definitely come to cut rates based on their dual mandate. Before I go any further here, let me mention today's video sponsor, Kraken Pro. Kraken Pro is a complete overhaul of the Kraken trading experience with a one-stop shop for advanced and professional traders. Kraken Pro enables efficient trading execution across multiple markets with a UI that allows for unique optimization tailored to your trading style. You can check out Kraken Pro with a link in the description of this video. Not investment advice. Crypto trading involves risk of loss. Cryptocurrency services are provided to U.S. and U.S. territory customers by Payward Ventures Inc., PVI, DBA, Kraken. Looking at BTC, we have been all over the place, and really the bottom line here for price going forward is the price is not real until US Open, because whoever keeps selling us off is mainly during US hours. So if, for instance, we are at 62 or whatever price in the weekend, Monday rolls around, Sunday futures open rolls around, and we do this again where we sell off 4% for no reason really, then you know who's leading the market, you know who's boss. It's not any other session. It's not weekend crypto people. It's very much the US that's in charge here in regards to price action. At least for now, that's been the trend. For Wednesday, would love to see something happen with price here. Higher high, lower low, anything. I'll take it. But I don't think the default expectation is, oh, rates are coming down, recession definitely coming, BTC definitely going lower. I'll believe that when I see it. Looking at volumes today on Kraken, Tether at the top here, which makes sense, more of a risk-off rally. And if you quickly scroll down this list, you'll see why it just doesn't make sense broadly to do anything with alts until BTC is clearly and obviously bullish once again. Alts will continue to bleed as they have for months, so long as we have this downtrend in BTC. Even the leaders, Sui I was talking about, that's down 4%. ETH falling further down this volume table below 20 million. So it really just doesn't make sense to trade alts right now. You know, Sol, let Sol be your guide. Sol will tell you when things are bullish. When Sol's at 200, we're ready to go, baby. We'll load it up, 100x long. No, I'm kidding. But that's the risk on metric. The risk on metric is Solana above 200. It's that simple. ETH above 3,000. It's got a ways to go. But across the board here, you will continue to bleed because alts are higher beta than BTC. Looking at US bond yields, treasury yields, across the curve, the lowest they've been all year. And you got to remember, everything is talking to each other. So yields down, prices up, yields down, meaning less attractive in a vacuum. And risk becomes more competitive when the front end of the curve isn't sitting at 5.25. Risk becomes more competitive when the long end isn't getting close to 5%. So I don't know how much more we can necessarily expect in this curve on the downside. I think the bond market is kind of getting ahead of itself. As far as the language, I'm not going to go through this, but just as a resource, bull and bear steepener and flattener, and what that means for markets. And that doesn't necessarily translate into bullish risk. Just a bull steepener is bullish for bonds, and that doesn't necessarily mean that's bullish for risk. Looking at the yield versus unemployment picture, we have uninverted pretty officially now over multiple days on the 10-2. Historically, this can be a warning sign for recessions, certainly something to watch out for. Will this time be different? The 10-year and the 3-month still deeply, deeply inverted. Neither is great at timing the exact recession, but the inversion of both has usually meant a recession shortly thereafter. So it's definitely something not to just ignore. Looking at the rates versus the 2-year, and this is the problem. This is the difference between what the market expects and wants versus where we are at. And the 2-year is pricing in a deep, deep continuous move lower. So again, to me, it makes more sense to look for bullish setups on risk than bearish setups on risk. Now, the bear in all of us is going to say, well, look at the past 3 times where the 2-year yield was this far below the Fed, it's been a recession. And that's fair. And again, you need to pay attention to that. You need to be ready to cut positions if things go south. But to be completely sitting out at this point in time seems a bit silly to me, especially because the dollar post-halving, post-BTC halving, is sitting on lows at 100 here, massive psychological level, and you can see what's happened 2016 halving, 2020 halving. None of this is new. Everybody's been talking about this for years. This doesn't need to go to 90, but if it does, again, do you want to be long BTC or not? That's the question. I suspect BTC does quite well. If DXY continues to move lower, we'll take 96. We'll take 98. Doesn't need to happen fast, but this does not look bullish for the US dollar. So bonds across the board today moving higher. Something I'll be watching on Wednesday is how do bonds react to what the Fed has to say in regard to forward guidance. These charts all measure higher on technicals. The 1 to 3 year price is close to where you'd expect it to go based on the trend reversal, but this could be a bullish trend. It was in a bearish trend for years. Nothing says this can't enter a bullish trend, but to me, the long end TLT still has the most potential upside relative to the rest of these options here across the curve. So the S&P still looks fine. We're sitting at all-time highs. And again, you've got people telling you, well, every time the Fed pivots, we've got XYZ drawdown. Okay, right? Let's see it. Let's see what happens. I'm completely open to that idea, but this is nowhere near bearish as of yet. We'll see how this looks Wednesday. Are we sub 5,400? Are we above 5,700? I suspect we're going to see a move one way or the other, and the way this is setting up now is higher. We are quickly back to very close all-time highs. All-time highs are not bearish. This is the Fed pivot versus drawdown example, and it's hard to fight history. So this is very real as a heart attack, and we'll see what happens. We will see what happens. If we look at the inversion date relative to the S&P, the average is still higher. 2000, 2007 are dragging the average down. 1980, 1982, we took off. So just because we have a recession doesn't mean the S&P goes lower, which is even wilder to think about. But that's certainly possible. That's certainly possible. Looking at the year-over-year difference between the S&P, 2023 is lining up a lot like 2024. And again, if we are anything close to this in Q4, what do you think BTC is going to do? Take a guess. So it very much makes sense to me to be ready for some upside here into the end of the year. The Qs, IWM, some of these other charts don't look as bullish to me, but they're clearly consolidating in this triangular fashion. Higher highs here would make more sense. It is on the bullish side of the cloud. Good things happen on the bullish side of the cloud. We don't need mega continuation. This doesn't have to go up forever. Nothing says this has to keep going. But trend is still favorable for a bullish move. IWM, you can also see this triangle here of consolidation. Not as ready as the S&P for highs, for sure. DJI also already sitting at all-time highs. Clearly fairly overbought. It's reached its cup and handle target. So I don't really know how much further this has in it, but it doesn't look bearish yet. Overbought isn't necessarily bearish. Overbought just says be careful. Be careful, this could roll over, just like gold. Gold looks overbought. It's looked overbought for a little while, a couple weeks now, and it still keeps going higher. Still keeps going higher. All-time highs are not bearish. It's that simple. So this looks good. For me, I'd rather just trade BTC because it moves harder, faster, stronger than gold ever will. And the same thing with silver. Man, the silver desperation on Twitter is something that you only see in the bowels of altcoin land. Just bag holders like you wouldn't believe. And the problem with silver is similar to gold. When it moves, sure, but it takes a long time for this thing to move. This is over a decade view here, and it's kind of gone nowhere in over a decade. This looks bullish. This should continue, but it could also take another 4 years to finally move. The target here is basically 50, but there are just so much other things you can trade to focus on. I just don't understand. Like, yes, this looks good, but if you look at the gold and silver ratio, this is headed in one direction and is not constructive for bullishness. Now you could say, well, maybe there's an Adam and Eve down here. Yeah, I'll believe it when it's at 0.1½ or 0.2. It's just not the time yet for that. And the silver and altcoin people, very similar to me. As far as tech is concerned, Apple to me does not look good. It really, really looks like M double top territory, diamond top territory. Now this doesn't have to break down to 160 again, but if we're talking about places I'd rather put my money, this is not a chart that I'd want to touch here. This needs consolidation. It needs time, not something, regardless of what it is, that I'd get excited about. Microsoft doing its best to negate head and shoulders concerns here. Certainly looks better than Apple, but it's still in this megaphone. Maybe just as frustrating as BTC to some people, right? It's flat. It's not trending lower, but it is flat since March and really hasn't gone anywhere as of yet. So if I'm looking for places to expect bullishness, top side here looks a little limited in the near term. And I just think there's better trades elsewhere. If we're talking about software versus semis, I mentioned this last night. These are the expectations where margin expansion will lead. Software, obviously, semis, energy, utilities, and you can see the rest of the list here. But this is where I want to be, at least if things look decent. We talked about IGV last night. I think that looks great. Hack is another one. That chart looks great. So there are just better places to be individually than Microsoft and Apple. Even NVIDIA just looks kind of tired. Doesn't look super, super exciting up here. PayPal is another one that, similar to like the 10-year, it's just been beaten down for multiple years, went sideways, put in its dues. Does this go to 160? I don't know, but it is set up for a bullish reversal, eventual bullish continuation here. As a chart, looks very, very good. Square trying to round the corner again. I think this is going to be a slow one. A lot of people watching this because of the BTC treasury they've got, the BTC sales they've got through Cash App. Something that to me gets a lot more exciting in the 80s than down here below. The weekly cloud. Pfizer, another one, just keeps kicking, just keeps rounding that bottom slowly but surely, and it's making higher lows month over month. At this point, until rates come down, I'll take it. This doesn't need to go to 40, but this is one place to be until BTC looks better. Here's another fringe chart, New York Community Bank. It has held sideways for a couple months here. As a setup, you've got defined risk reward with a stop loss at lower lows. The daily looks good, the 2-day looks good, the weekly looks good. Does this go to 20, 30? I don't know, right? But as a setup, it looks pretty good to take a punt, as they say. I would much rather jump into a chart that's been sideways for months than that's headed minus 50% in a couple months. It takes time for this stuff to normalize. And you don't usually see some crazy V bottom, just a lesson in patience. Before I close here, I'll mention 2 macro vids that I like this week. Jeffrey Gunlock of Double Line does one every quarter, and I don't necessarily agree with everything he says, but I really like how he presents the data. And there's a lot of data in here in the 45-minute presentation. Bolello also does great stuff on Twitter, great charts, does a weekly rundown that's more legacy focused than even I put together. So the big kahuna this week is obviously the Fed. 2 p.m., be there. It's going to be an exciting moment for the markets. That's all I have for this one. Like, dislike, comment, share, subscribe, and happy trading.